So like 18 or 19% of all venture capital dollars is under the management of Andreessen Horowitz right now. So like 1 out of 5. We've basically 10x the amount of companies that are owned privately. Most startups don't IPO anymore. The second way was acquisition. So that's just, somebody acquires you. Problem with acquisition is if you look at the numbers, most acquisitions aren't billion-dollar acquisitions. Most acquisitions are 50 million,
Yeah.
100 million, 200 million, 400 million. Great numbers, by the way, but not for investors. This has changed now because entrepreneurs have A, gotten smarter. They want more control over their company. B, funds around the world are experimenting with new and different ways to get at these brilliant founders that are doing different things. 3, liquidity has shifted. And I think
Yeah.
what we're seeing now is emerging asset classes. We're literally seeing innovation in real time. I started this thing about 6 months ago called post-unicorn capital. And it's just trying to track these changes because I started witnessing it. I travel the world for my work. And there's over 60 funds right now that I would say that are already in venture adjacent territory, where it looks and smells a little like venture, but often it's not unicorn model. It's something different. There's already 60 funds.
That's interesting. And so if it's already at 60, how long do you think until this becomes, you could agree that the funds like A16Z, Y Combinator kind of dominate the space in terms of narratives and with their innovations? How long do you think until these alternatives become more mainstream?
Depends where you are. I think to some extent in some parts of the world, they already are mainstream. So A16Z, so like 18 or 19% of all venture capital dollars is under the management of Andreessen Horowitz right now. So like 1 out of 5. It's insane. It is already becoming normalized. What's interesting is, and I love this stuff. I'm an innovation geek, tech geek. I love emergent behavior, emergent technology, when things just happen without us planning it. I think we're already there. So there's 2 particular asset classes. There's several more, but 2 particular asset classes that I pay attention to probably closer than the other ones. One is called permanent capital, which is the idea that I'm planning for a non-exit. And you might say it looks like debt, but it's kind of a little bit different than debt. But there's a number of firms around the world that are basically, they get cash dividends off the business. They invest in cash flow positive businesses and they get amount of money. So permanent capital is an interesting one. And the other one is called SMV, which is small and medium venture. And these are designed for portfolio construction of $50 to $500 million of exits. So it's not a unicorn exit, but it's not the power law because it's planning many more exits in a faster period of time. And again, I'm already seeing funds that are building their portfolio. Some are even on fund 2, fund 3.
That doesn't sound too bad though. Honestly, from my perspective, it sounds like a win because in a typical VC model, I don't know if you mentioned this, but it's like a 10-year run that you're waiting for that $1 billion exit or the IPO. But if less companies are IPOing, if they're not guaranteed to make that 10-year mark, if they could fail before, this might be like a nice happy medium,
It is for everyone except one group. Well, put your hat on or an LP hat. And this is the problem. And what we need is to re-educate the LPs. Because at some point, a sophisticated LP will sit there and say, look, I invest in VC as a gamble. It is a gamble. I'm going to lose most of my money, but if I don't, I'm going to make $1 billion. And if I'm not going to do that, and if I'm going to go to a safer investment, then there's a lot of vehicles. There are a lot of options. I can invest in real estate. I can invest in index funds for gosh sakes. I can invest in a lot of things. So that's the other side of it. I have counter arguments, but I do want to recognize the other side of it, right? Which is the LP community could arguably say, look, if I'm not going to get the fantastic returns, I'm going to go invest in commercial building or invest in Ford. Well, why am I going to invest in this thing that I could get, I don't invest in Ford because I can make $1 billion. Now you're giving me an option where I can make a little bit more, but I don't have to. So that's the argument. Good.
I got a question for you on the LP thing though. Is that something that bothers them, or is it just like the time? Is time also a factor here too? Because something I think about when I've spoken to LPs is their timing of just getting to their exits faster is something that they've been interested in. And that's why I've literally had people tell me they don't want to go into venture because it takes so long. So I would think that something like this with, if you can cut the time in half, that might be more viable to a lot of people.
That and the 2 and 20, right? So the fees are the other problem that the LPs have. It's like, I'm funding your acquisition. So if you do have a model that can get to acquisition faster, You can also get the cash faster, and you could possibly get the fees lower. These are all factors, right?
Yeah.
Summer 2026. I'm not going to have all the answers now because this is being written right now in time. If you look at the country of Brazil, Brazil spent the last better part of 10 to 15 years actually retraining their LPs. And the idea there was Brazil really wanted to make a splash onto the startup scene. They're doing quite well. And they realized that they couldn't just import the Silicon Valley model. And if they went for, unicorn or bust, it would be bad for society. It'd be bad for their country. Whereas we want more people to succeed and more money sloshing around in a faster time periods.